The Seattle metropolitan area housing market was one of the top markets in 2021, but in 2022 it is becoming one of the worst performing markets. In today's video, we're going to look at where things stand for the housing market supply and demand in the Seattle market, as well as how far we could expect home prices to fall and how long it could take. Let's get into it. The Seattle metro area has a lot going for it in terms of market fundamentals, foremost of which is the presence of the technology industry there, which is one of the biggest tech hubs in the nation. Big names like Microsoft and Amazon are headquartered there, in addition to numerous other tech companies. But in the face of a housing market that has turned and the nationwide tech sector seeing layoffs across the industry, it leaves us wondering what the direction is of the local housing market. According to the latest data from Redfin, a national real estate brokerage, the median price for a home in the metro area was $778,000 in October, down 4.2% from the peak in April. Is the worst behind it, or is the downtrend just getting started? What we're going to cover today is the supply and demand statistics to get a sense of the current health of the Seattle market, and then go beyond the current statistics and gauge the future direction of home prices. On the supply side, inventory levels have been on the rise over the last year and have now returned to where they were before the pandemic. The increase in active listings is not a result of an increase in new listings, however, which have fallen below pre-pandemic averages. Homes already on the market are staying there longer, as the average days on market has been rising over the last year as well. Supply is still relatively low, but is increasing due to weakness on the demand side of the market. Home sales have collapsed and are now trending well below pre-pandemic averages. As of October, there were 2,980 sales compared to 3,358 new listings. This is why we're seeing inventory levels increasing. Even though new listings are falling hard, there are still more listings than there are sales occurring. This is why we're seeing the month supply of homes on the rise as well. This measures how fast the current inventory would be exhausted at the current pace of sales. The weakness in demand can be seen further in the sales to list price ratio, which is steadily trending lower despite a slight uptick in October. The bidding wars are nearing an end, and when this metric falls below 100, meaning homes are selling below list price on average, we could see an acceleration in price declines. The underlying supply and demand statistics aren't looking good for Seattle right now. Pretty much everything is trending in the wrong direction. Supply is increasing while demand is decreasing, and that's a tried and true recipe for lower prices. Now, let's take a look at how low prices could go and when we might see a bottom. Before I get into my projections for home prices in Seattle, I do need to drop my usual disclaimer. This video is for informational purposes only and is not financial advice. I am not your financial advisor or your real estate agent, and you are responsible for your own financial decisions. Okay, when considering how low prices could go in Seattle, it's important to remember the primary driver of the current price declines, and that's mortgage rates. Due to the Federal Reserve's fight against the highest inflation in 40 years, mortgage rates have surged and created a sudden shock to housing demand. After the big run-up in prices over the last 2 years, the average home was barely affordable. And with the surge in mortgage rates this year, it has become extremely unaffordable to the average resident in Seattle. I've calculated the average housing payment as a percentage of the median household income, and right now Seattle is at 54%, much higher than the 42% seen at the peak of the last housing crisis. Excluding the time since March when the Federal Reserve began their campaign to raise interest rates, the average for this metric in my data going back to 2005 is at 32%. This would be a reasonable level to expect affordability to return to in a balanced housing market for Seattle. But right now, I'm going to look at what would happen for this to reach 40%, which has historically been an upper limit and represents getting back to a more affordable level, even if it is on the higher end. This may not be too unrealistic given that the tech industry in Seattle is highly ranked in the country, and employees in this industry typically command higher wages above the median household income in the metropolitan area. So, in assessing how low prices could go, I'm going to assume the average housing payment as a percent of income will return to 40%. This leaves me with two other variables to consider: income and mortgage rates. For income, I'm going to assume that it will grow at the historical average rate from the last 10 years. For mortgage rates, I forecasted in previous videos that mortgage rates will reach 7.6% by May of 2023 based on the Federal Reserve's dot plot, or their expectations of where their Fed funds rate will end up in 2023, and then pause to see how inflation reacts. Honestly, after looking into this more, I don't see mortgage rates coming down anytime soon, and here's why. Inflation is what the Fed is trying to bring down, and assuming it peaked at 9.1% back in June, it has fallen by an average of 0.3 percentage points each month. Let's assume it keeps falling at that rate. It wouldn't reach their target rate of 2% until May of 2024. Given that, where would the Fed funds rate have to be? Well, back in the 1980s, they had to keep the Fed funds rate at an average of 2 times the rate of inflation to make sure it didn't pop back up again. So even if the Fed fund rate reaches 5% by May 2023, as I expect it to, and stays there, it wouldn't reach 2 times the rate of inflation until March 2024. And this isn't some crazy assumption that just I am making. The New York Fed President John Williams recently came out saying the Fed's fight against inflation could last well into 2024. So for our calculations, I'm just going to assume that once the mortgage rate hits 7.6% next year, it's going to stay there in that neighborhood until March 2024, and then the Fed will start to lower their Fed funds rate in line with the lower inflation rate, and mortgage rates will come down a bit after that as well. And all of this assumes the Fed doesn't break the economy with higher interest rates and has to pivot sooner than expected and lower their Fed funds rate earlier than this timeline indicates. If you want to keep track of the overall economy and whether or not the Fed is breaking it, check out my other channel, PapayaCast, where I provide forward-looking analysis on the overall economy about once a month. I'll have a new video there soon with the latest outlook for the U.S. economy. So, we have our assumptions laid out for mortgage rates, median household income, and the average housing payment as a percent of income. There's one last consideration: how fast prices could decline. Looking back at the last housing bubble, the median price for an existing home in the Seattle metropolitan area declined from $390,000 in the third quarter of 2007 to $272,000 in the fourth quarter of 2011, according to the National Association of Realtors, of which I am a member. That works out to $2,300 decline per month in the median price. Fast forward to today, and we see the median price decline from a peak of $812,000 in April this year to $778,000 in October, which works out to a decline of about $5,600 per month. So far, we're seeing a much steeper decline in prices, which makes sense given how fast mortgage rates have risen. But I think that rate is going to slow down given that mortgage rates are likely to flatten out over the next 6 months or so. So for the sake of simplicity, let's split the difference and assume prices will decline at a rate of about $4,000 per month going forward. Putting all the numbers together, the average housing payment as a percentage of income would reach 40% in December 2024, and it would happen when the median home price reached $674,000. This represents a 17% decline from the recent peak in April. While this is a significant correction, it falls short of a full-blown crash in the Seattle market, which would be more in the neighborhood of a 30% decline. This may sound like a long time for prices to be falling, but housing markets don't fall as fast as things like the stock market. Just looking at the last housing market decline in Seattle, prices were declining for 17 quarters or 51 months for prices to go from peak to trough. So this is where things currently stand for the Seattle metro area housing market. Obviously, things could change if we see further increases to mortgage rates, drops in income from a recession, or the average housing payment as a percent of income settling in at a lower or higher rate. But given all the assumptions I laid out earlier, we're looking at a 17% decline in home prices by December 2024. If you want to stay up to date on the state of the housing market throughout the country, make sure you're subscribed to this channel and hit that notification bell down below so you know right away when my next video comes out. And if you liked this video, please give it a thumbs up to support the channel and help it grow. Thanks for stopping by, and I'll see you in the next video.